Day trading Visual Basics was built or predicated on the premise that we would locate, or it was a uh, reversal recognition identification system. Now, if you're thinking along those lines and you're developing plans to create a system that identifies reversals, you're obviously dealing with cycle lows and cycle tops, and you're identifying or trying to identify those points of pattern reversals, and you're trying to pick up on the strength of those turnarounds. Because the one thing that we've all noticed is that sometimes a cycle bottom can occur, and then it might take 3, 4, 5 days for it to really start climbing back up. And so we often get moderate or slow cycle reversals, but then again we get real strong turnarounds and go up real fast. And so to identify those stocks that would have a strong or a fast turnaround, I needed to identify the strength of a movement. And this system has two key elements to identifying strength, and that is line length indicators, or I should say the line length of indicators, and divergence. Now, examples of line length indicator would be like a bottom of cycle pattern or a BOC pattern in which the right leg is longer than the left leg. And when that happens, that particular day that you have that long leg that's built, that day is stronger than a day where you would have a BOC lower pattern in which the right leg was shorter than the left leg. There's not as much strength, there's not as much power, but a longer right leg has more strength, more power, more push. And I might add that when you have the turnaround and it immediately is identified as stronger, that strength is oftentimes carried through for the next a second or a third, fourth, sometimes a fifth day. And so it's actually the power of day one when that BOC pattern forms. And by the end of the day, you recognize whether it's a BOC higher or a BOC lower pattern. Other examples of line length strength are in the zip red indicator. Zip red and zip pink, as you may know, are the two fastest indicators or the quickest indicators in the system. And zip gray, of course, is zip red's partner, and it is just as fast. Now, those can move really quickly. Swing pink just turns on a dime. I mean, it instantly recognizes tiny market force changes just immediately. But the difference between the two is that zip red moves with real long line length movements, whereas swing pink does not do that, relatively speaking. Zip red can move 30 or 50 or 80 points. I mean, I've seen it go from under 5 to over 95 in one day. And the one thing that you will be surprised at is when ZipRed moves that 70, 80, 90 points, the price can oftentimes be very flat, just move up a few pennies, and in fact can go down a hair, a few pennies. And so that is divergence in itself, but but mixed in with that is what we refer to as capital DIFF, or the difference in movement. You can see Zip Red go up 70 points and Zip Gray go up 40. There's a 30% difference. And other times Zip Gray and Zip Red will spike up and Gray will be above Zip Red. And if you're not aware of it, whenever Gray is above Red in a spike up, then it's a stronger high probability of going down the next day. And the same when it's on the bottom. If Zip Gray sticks out of the bottom in a spike down, there's a increased high probability that it will go up the next day. So you have different types of line length movement, not only in indicators, but in patterns. You also have divergence. And divergence is just basically, when we think about it, it's one up and one down. It's one indicator line up, and what it represents, obviously, is opposing forces. The indicator lines are tracking market pressure or market forces within the system or within that particular stock. And they're using methods to track that pressure. And so when one line goes up and one line goes down, we have opposing pressures. Even more importantly, when you have patterns that go up or down, for example, like a TOC lower pattern versus a TOC higher pattern, or the opposite, BOC, some indicators are BOC lowers and some indicators are BOC highers. When an entire pattern represents a divergent move, then things can even be stronger in their reaction. And it's just like when you see a TOC pattern. It's designed to occur at the top of a cycle. It's one up and one down. The lower pattern on the top of the cycle is more powerful. It's pushing down harder on that day that the top of the cycle turns around and the trend starts going back down. But what if you see the top of the cycle lower pattern at the bottom of a cycle? So now that in itself is divergent, and then when you throw into it the TOC lower pattern, it causes a push down reaction too far and goes back in a reaction the opposite direction next day. It's a classic case of somebody within the system just pushing the price way too low, far beyond where it should go. Others will refer to it as being overbought or oversold, which is exactly the case, but we recognize it in indicator format, and we can see it real clearly and identify it. And so there are just many different types of of divergent moves. And so you can have power pink and blue up and power white and yellow down. That's a fantastic divergent condition for gap up. And obviously there are many other types of divergent conditions that occur. These two types of activity are the primary methods that we use within the system to identify strength within a system or the power within the movement that's taking place. With divergence, divergence is actually one of the key elements to gaps. We often see a lot of divergence with gaps. And I'll emphasize this by saying we have 22 market force recognition indicators that are built, but they're very sensitive. And because of their sensitivity, we pick up a lot more divergent conditions than I'll say the average might see, or I'll say that the standard indicators on the TradeStation platform would show you. This system is, with its sensitive indicators, might show 2 or 3 or I don't know how many times more divergence conditions simply because of its sensitivity. So those are the two methods that we can identify the strength. We know there's significant activity on the day one of the cycle turnaround, and it's those indicators that or stocks that we like to find, and we can find them through scans and through radar screen. And of course there's any other tools that you can use in TradeStation as well for your purposes, but those are the two tools that we use foremost in this system, simply because it keeps it basic. It is they're easy to use, and they're formulated, or excuse me, the process of formulating scans or creating radar screens is very simple. And at the heart of the entire system is keeping it simple, because we were beginners back in 2007, and it's over 10 years ago now, but when you don't understand something and you're having trouble with something and you need to, like personally, I was very inconsistent in my trading activity. I would be successful on one trade and lose on the next. And so I needed to find a method or a technique or a process, or we ended up with a system. We ended up with a formula, because we take those patterns. We have over 20 pattern types up and 20 pattern types down in those two examples, or in those two groups. And 3 of those groups, the identical indicators, the down touches, and the proximity group, those 3 groups together are the 3 groups that we analyze gaps and identify and find gaps. And so there's a lot of power within this system. And it started with us trying to grab a hold of strength.